So this question looked at consolidations. So last week you would have had a look at how to account for a consolidation with NCI and various other aspects. So let's have a look at this question. So Talk Talkie Pty Limited bought 150,000 Class A shares in SpringCon Pty Limited on the 1st of January 2019. On this date, SpringCon had share capital of 520,000 and retained earnings of 530,000. There was also a non-distributable reserve of 80,000. All the assets and liabilities of SpringCon Pty Limited were considered to be fairly valued on that date. SpringCon Pty Limited has not issued any shares in the period to 31 December 2019. The following are extracts from the statement of profit or loss and other comprehensive income for the two companies for the year to 31 December 2019. So here we have the statement of comprehensive income for both individual companies. Talk Talkie does not have any other investments apart from their investments in SpringCon. Talk Talkie carries their investments in financial instruments at cost. Goodwill is amortized on a straight line basis over a period of 5 years. And then here we can see they've given us the post-closing trial balances of Talk Talkie and SpringCon as at 31 December 2019. So the first required is to create an Excel sheet based on the analysis of owner's equity template below. So that is the required one, is to complete an analysis of owner's equity. If we go to the next page, we'll see that step 2 requires us to prepare pro forma journal entries required to eliminate Talk Talkie's investment in SpringCon. And 2.2 wants us to prepare the pro forma journal entries required to allocate the non-controlling interest share of SpringCon's profit for the year. Step 3 wants us to prepare the consolidated statement of financial position for the group. Step 3.2, we'll be looking at how to prepare the consolidated statement of profit or loss. And then step 3.3, prepare the consolidated statement of changes in equity for the Talk Talkie group for the year ended 31 December. Okay, so that is the required. I'm going to stop sharing the question now. What you can do so long is that I want you to work out what is Talk Talkie's ownership of SpringCon in percentage terms. So they tell you there that there were 150,000 Class A shares that were bought. So please work out what is the ownership there. Okay, I'm just going to stop sharing this and then share the solution. Okay, so you guys can see the Excel document there. Let me just go to the top. Okay, so the first required was to prepare the analysis of owner's equity. Here you'll see that they just have the information given from the scenario. So they gave you this profit and loss statement and the trial balance here. Okay, so I asked you what ownership does Talk Talkie have of SpringCon, and it was 60% ownership. So because they own 150,000 shares as a total of 250,000 shares. Tok owns 60% of SpringCon. Okay, well done. So now we need to look at the analysis of equity. So remember, this can be broken down into three parts. It can be broken down into at acquisition, and then it can be broken down into part B, which is the time after acquisition before the current year. Then we'll have part C, which is the current period. Okay, so in today's lecture, we looked at the period between and we saw how to calculate retained earnings for that period. But for this question, it just focuses on current year acquisitions. Okay, so we have to do the analysis here. So the share capital here is showing the equity of SpringCon. So SpringCon had share capital of 520,000. They had retained earnings of 530,000 and a non-distributable reserve of 80,000. So Tok only owns 60% of this. So you can calculate the ownership of Tok at acquisition here. And then the remaining 40% belongs to the non-controlling interest. So Tok owns 60%. There's 40% which are other minority shareholders, and they own 40%. So you can calculate NCI here by taking share capital, multiplying it by 40%, and that will give us NCI's share of share capital being 208,000. And it's the same with retained earnings. There'll be retained earnings of 530,000 of SpringCon, and Tok will own 60%, which is 318,000, and then NCI will own 212,000. And it's the same with the non-distributable reserves. So if we have a look at the question, it doesn't specifically say in the paragraph how much was paid, but we can actually see how much was paid by looking at the trial balance given to us. So it tells us there the investment in SpringCon was 700,000 Rand. So this represents how much was paid for the equity of SpringCon. Okay, so if we go to our analysis of owner's equity account, we know how much was paid for 60%. Now we can calculate the goodwill. Okay, so when you are trying to calculate goodwill or gain on bargain purchase, and there isn't a wholly owned subsidiary, like in this case, we have NCI, when you are calculating your goodwill or your gain on bargain purchase, you need to compare the consideration paid to the ownership percentage of Tok. So you cannot compare the 700,000 to the total equity of SpringCon because they don't own all of it. So you can see here we are taking the consideration of 700,000 and we are subtracting the 60% of the equity of SpringCon. And that will give us goodwill of 22,000. They told us in the question that the goodwill must be amortized over 5 years. So sometimes they will tell you in the question how to amortize the goodwill. If they don't tell you in the question what period to use, what period are you going to use? If they don't tell you in the question, if the question is silent. Okay, well done. So if the question is silent, you're going to use 10 years. So we can see in our situation, we have goodwill of 22,000. And we can see that the NCI at acquisition has a balance of 452,000. So this will go under acquisition of subsidiary in the statement of changes in equity. So we'll come back to this when we do the statement of changes in equity. So because the acquisition took place at the beginning of the current year, part B is blank, okay, which is normal. Let me just try and make this thing smaller. So now we look at part C. So what is the profit for the period? If we go to the top where they gave us this information, we can see that Spring Khan made 700,000 Rand profit for the current period. This now needs to go in the analysis of owner's equity. So 700,000 profit that Spring Khan made. How much does the parent get? So TalkTalkie will get 60% of this, which equals 420,000, and NCI will get 280,000 of this, okay? So we will have to allocate NCI 280,000 of the current year profit. So now that we have calculated our current year profit, you can total up each column and we'll see where these go in the various statements. Okay, so that is the first question. So that was the first question. Now, if we look at the second question, they asked us about all of those journal entries. So 2.1 asked us to process the at-acquisition journal entries. So the at-acquisition journal entries here would be to debit share capital of 520,000, debit retained earnings, and debit non-distributable reserves. When you do your elimination, your at-acquisition elimination journal entries, you're using this amount over here, these amounts for 100%. Okay, so those are the at-acquisition journal entries. One thing I forgot to mention is the dividend of 10,000 Rand. Can anyone tell me how we calculated that? So the question said, so if you look in the amounts that were given to us, so if you have a look at the top here, it says TalkTalkie received dividends of 6,000 Rand. Springbok received 25,000 Rand. So TalkTalkie received 6,000 Rand in dividends, and the question told you that they did not have any other investments besides that investment in Spring Khan. So if TalkTalkie received dividends of 6,000 Rand, and you know that this all came from Spring Khan, how do we calculate the total dividend paid? So you know that if there was a dividend declared and paid by Spring Khan, that dividend, only 60% of that dividend would go to TalkTalkie and 40% would go to the non-controlling interest. So if TalkTalkie received 6,000 Rand in dividends in the current year, and you know that this full amount came from Spring Khan, then you know that this represents 60%, and then NCI would get 40%. So the total dividend declared and paid will be 10,000 Rand. Okay, so that's where the 10,000 Rand comes from in the analysis of owner's equity. Okay, but if we go back to the journal entries here, we have eliminated our investment in our subsidiary, which was 700,000 Rand, against the equity purchased. And we calculated goodwill as being 22,000 Rand. Now, because we eliminated 100% here of equity, but we only owe 60%, we need to show the non-controlling interest portion, and this will be shown in the statement of financial position. Okay, so that is the at-acquisition journal entries when you have non-controlling interest. If we go down to the next journal entry, in step 2.2.1, here we need to give the pro forma journal entry to allocate the non-controlling interest share of profit in the current year. So here we're going to allocate the portion of the current year profit that belongs to the non-controlling interest. So if we go up to our analysis of owner's equity account, remember I said that the current year profit was 700,000 Rand. The parent share is 420,000 Rand, and NCI will be allocated 280,000 Rand. So that is where that number comes from. The 280,000 Rand is NCI's share of the current year profit. Then we need to have a look at this intergroup dividend. So remember that in the individual books of the subsidiary and the parent, it is okay to have this dividend received by the parent from the subsidiary. But when we're preparing the group financial statements, it's basically we've declared a dividend to ourselves, which is very strange and not proper in terms of accounting. So we need to eliminate this intragroup dividend. And we're going to do that by saying debit dividends received. We're reversing the portion received by the parent, and then crediting dividend declared with the full amount. And then we're also showing here that we're debiting non-controlling interest from the statement of financial position. Okay. So here we have eliminated the intragroup dividend. So now when you see the consolidated set of financial statements, you will not see the portion between the parent and the subsidiary. Okay. So if we have a look at the last journal entry here, so remember goodwill will only be recorded in the group financial statements. So in the separate financial statements of the subsidiary and the parent, no goodwill will be shown relating to this acquisition. However, when we prepare the group financial statements, we need to show and record goodwill. And we recorded the goodwill in the at acquisition journal entries. But now remember, we need to amortize this goodwill. And we said that in this situation, they told us to amortize goodwill over 5 years. So we have taken the amortization, we have taken the goodwill of 22,000 Rand, and we have divided it by 5 years to get the current year amortization of 4,400. And the journal entries to record this amortization are debit amortization, credit accumulated amortization. Okay. So those are the journal entries. So when we take the analysis of the owner's equity, when we take the analysis of owner's equity and we add in the pro forma journal entries, this is going to help us prepare the group financial statements. Do you guys have any questions at this stage on that first part? Okay. So if we go down to the statement of financial position, we need to just have a look at how they calculated everything. So remember those steps you learned in the consolidation process. It says you need to perform your at acquisition journals, your pro forma journals, where you eliminate the equity in the subsidiary against the investment in the subsidiary. Then you need to look at step 2, and in step 2 you look at intra-group transactions or balances. So we've done those two. Then one of the steps next is to add line by line talkie with SpringCon to get the consolidated figures. So here, property, plant and equipment, talkie is 1.5 million, SpringCon is 900,000. That will give us a consolidated figure of 2.4 million. And this will go in our statement of financial position. Okay, this is just the working. Investment in SpringCon, this was shown in talkie's individual financial statements. However, remember we processed the pro forma journal entry of 700,000 Rand to eliminate this investment against the equity of SpringCon. So therefore, in our group financial statements, there will be no investment in SpringCon. Okay, they seem to use Springbok and SpringCon interchangeably, but it's the same company. Then we have investment property. So talkie doesn't have any investment property. SpringCon has 400,000 Rand of investment property. So if we add this together, it's nil plus 400,000. That will give us 400,000 investment property in the consolidated statement of financial position. Then remember we recorded goodwill. Neither Tok or Springcon have goodwill in their separate financial statements. However, we recorded goodwill of 22,000, but then we also had a journal entry to amortize that goodwill. So if we take 22,000 minus the amortization of goodwill, which was 4,400, that will leave us 17,600. So that is the goodwill. Then we have, does someone want to ask a question?
Yes, ma'am, I have a question. So under PFGE for goodwill, sometimes we use the amortization amount, and then other times we're using the difference of what should be in the consolidated financial statements. So which amount do we have to put in a test or an exam?
Okay, well, if you think about what we're doing, we have to have goodwill in our statement of financial position. So the goodwill would have been recorded on the 1st of January, which is the beginning of the year. So it's correct to write 22,000 Rand being the goodwill, and then to show that that goodwill was amortized. So you can write 22,000 less the amortization of 4,400, and that will give you 17,600. It depends when the acquisition occurred, because if the acquisition only took place on the 31st of December, you would have goodwill, but you wouldn't have any amortization. So because this acquisition took place on the 1st of January, and now we're preparing the financial statements at 31 December, a whole year has gone by. So we need to amortize this goodwill. So in this situation, it is correct to show goodwill of 22,000 Rand less the amortization of the goodwill. Okay, does that answer your question?
All right, thanks, ma'am. Yeah.
Okay. Okay, so once we've had a look at our non-current assets, now we have to look at our current assets. So here we have our trade receivables, our inventories, and our bank. So here we are simply adding Tok plus Springcon. So trade receivables, we're going 440,000 plus 115,000, and that will give us 555,000 Rand. Then we have inventories. Tok has 290,000. Springcon has 144,000. Once this is added together, the consolidated inventory figure is 434,000 Rand. Then we have bank. Tok has 145,000 Rand plus Springcon being 278,000 Rand. Consolidated, this will give us 423,000 Rand. Okay, so that is the assets. That is the total assets in the consolidated statement of financial position. If we go down to the equity and the liabilities, so the first item we need to consider is the share capital. So the share capital, we're obviously going to take Tok plus Springcon, and we're going to add it together. But remember, we would have reversed and processed a pro forma journal entry to eliminate the equity in Springcon. So the share capital, we go Tok plus Springcon plus the pro forma journal entry column, and that will give us a total share capital of 1.2 million. Then we have retained earnings. So here our retained earnings is going to be made up of Tok plus Springcon, but then remember we would have eliminated a large portion of the retained earnings. So this retained earnings figure here, the pro forma journal entry to retained earnings, is made up of the retained earnings on acquisition. So that 810,400 Rand, that is made up of three items, which I'm going to show you. So if you have a look, do you agree that when we had our acquisition, we would have eliminated all of the retained earnings pre-acquisition in SpringCon? So that 520,000 relates, sorry, 530,000 relates to the pre-acquisition retained earnings, and we need to eliminate that. Then we had NCI's portion of current year profits being 276,000. So we also need to show that a portion of SpringCon's retained SpringCon's profit will actually go to the non-controlling interest. So you will include in that pro forma journal entry 276,000. Then the last component of that pro forma journal entry will be the journal entry relating to the amortization. Okay, so when we amortize goodwill, if you look at your consolidated statement of financial position, it doesn't show the accumulated amortization. So the accumulated amortization will be processed through retained earnings. So we also need to include in this journal entry the accumulated amortization amount of 4,400. So if you add up those three amounts, being the 530,000 pre-acquisition retained earnings and the 276,000 retained earnings or profit, which is attributable to NCI, and the 4,400 amortization amount, that forms the pro forma journal entries total for retained earnings. Okay, so I'll put up this Excel document so you can have a look, but those three amounts have been included in here. In a test or exam, you can show those amounts separate. Okay, I would recommend showing them separate or showing a total here and then referencing your workings. Because if you show a total and it's incorrect and you haven't shown your workings, it means you could be losing potential method marks. So it's better to show a total or show the three amounts making up this total here, but just show your workings. Okay, if you show the total, you need to reference to your workings. Okay, that 276,000, this is coming from the analysis of owner's equity. It is this amount over here, H55. That is the portion of retained earnings that is attributable to NCI. Okay. Someone is asking, how do we show workings online? Perhaps if we asked you to type something, obviously if it's multiple choice or jumbled sentences, you can't. But if it's a written, like a short answer question, then you could. But just keep in mind, we won't be online forever. So maybe next year, or if you ever study again, you'll remember to show your workings. Okay. So why are we adding the accumulated amortization and not subtracting it? Okay, so we're actually adding three numbers that are all negative, if that makes sense. So let's just go down to our workings here. So I'm not sure if you can see, but that G61, that is the pre-acquisition retained earnings. Okay, so we're basically adding three negative numbers, and that is how we got this negative number here. So you can think of it as adding or subtracting a negative number minus another negative number minus another negative number, or you're adding three negative numbers. Doesn't really matter. Both of those will get you this answer here. Okay. So that is retained earnings. Gain from bargain purchase. In this situation, we had goodwill, so we did not have a gain on bargain purchase. Then we have our non-distributable reserves. So here we are adding the parent and the subsidiary, and then also the pro forma journal entry column. So remember, we eliminated the non-distributable reserve of the subsidiary on acquisition. So this is going to give us a total which consists purely of the parent's non-distributable reserves of 200,000 Rand. Then we have non-controlling interest. So non-controlling interest consists of 728,000 Rand. And if you go up to your statement of analysis, you'll see that that 728,000 Rand, this is the total. This is the at acquisition amount and the current year profits. So that 276,000, that is the current year profits to NCI, but the 728,000 is the total of the at acquisition non-controlling interest and the current period profits attributable to the non-controlling interest. Okay, let me just scroll down. Okay, so the non-controlling interests in the parent separate books and in the subsidiary separate books, neither of them will have any NCI. It's only when the group financial statements are prepared that we'll be raising non-controlling interest. Then we have trade and other payables. So we're simply taking the parent and the subsidiary and we're adding that together, and that will give us a consolidated trade payables figure of 32,000 Rand. Okay, so that is the statement of financial position. So if you go up here, these are the workings. All of these figures here in the statement of financial position, they all represent that final column that we went through. I just wanted to show you the workings. Okay. Now that is the statement of financial position. Let's go have a look at the next statement. So here we have the statement of profit or loss and other comprehensive income. So the working is on the side here. So these figures all come from the information they told us in the scenario. So profit before investment income, here we are simply adding Tok Toki and Spring Khan. Let me just show you where these come from. So if you go to the top, this was given in the question. So you're simply adding Tok Toki and Spring Khan. So if we add the profit before investment, we get a consolidated amount of 2.1 million. Then we have dividends received. So remember, Spring Khan received dividends of 25,000 Rand. This was obviously from someone else outside the group. Tok Toki received dividends of 6,000 Rand, and this was all from Spring Khan. So because Tok Toki received these dividends from Spring Khan, and it is a parent-subsidiary relationship, this is an intra-group amount and it needs to be eliminated. So we eliminated that 6,000 Rand. So the only amount to be included in the dividends received are the dividends that Spring Khan received from an outside company. Then we have our amortization expense. So because goodwill was recorded on the 1st of January and now it is the 31st of December, we have amortization for 1 year. So that is where the amortization expense comes from. And remember, we recorded those pro forma journal entries. Once we total all of that, we'll get profit before tax. And our tax expense is a function of adding Tok Toki and Spring Khan. And this will give us profit for the period. So once we have profit for the period, we can split this profit between owners of the parent, being the main shareholder, Tok Toki, and the non-controlling interest, being the minority shareholders. So the non-controlling interest figure will come from your analysis of owner's equity. So that 280,000 Rand, this is going to be recorded there as the non-controlling interest share of the current year profit. So this is where that 280,000 Rand comes from. Then once we take that non-controlling interest amount of 280,000, and we know the profit for the period is 1.595, the owners of the parent, this is the remaining balance. So we're simply taking the total minus the non-controlling interest, and this will give us owners of the parent. Okay, there's a bit of rounding differences in this Excel spreadsheet, but usually this would be a method mark. We don't expect you to get it right, but we expect you to follow the correct process. So remember in the lecture today, we said that the statement of comprehensive income should show profits attributable to owners of the parent and the NCI. Then we also need to show total comprehensive income attributable to the owners of the parent and NCI. So the difference is other comprehensive income. In this question, there is no other comprehensive income, but we still need to show it in financial statements. So we'll take down the total comprehensive income of 1,595,600, and then again we'll split it between the non-controlling interest and the owners of the parent. So the non-controlling interest is 280,000, same as this one, because there's no other comprehensive income. And the owners of the parent again is the balancing figure. Okay, do you guys have any questions? Okay, so that is the statement of comprehensive income. Now our last statement to go over is the statement of changes in equity. Now this is where a lot of you might struggle a bit, especially with the retained earnings column. But let's go through it systematically. So remember we said that the share capital in the group financial statements, this is only going to consist of the parent's amount. The share capital of the subsidiary was eliminated in that pro forma journal entry. Then we have the opening balance of retained earnings. So in this scenario specifically, they haven't given enough information to calculate this figure. So in this figure, I have put a number there that I feel could represent it. But in a test or exam, it's unlikely we'd give you a situation like this. We like to make sure that all of the information is there, okay? But just be aware in this scenario, if you're trying to calculate this figure, there isn't actually enough information to calculate this figure. Then we have our non-distributable reserves. So our non-distributable reserves, this 200,000 Rand is the parent's non-distributable reserves. The non-distributable reserves of the subsidiary would have been eliminated on acquisition. So once we have the total opening balances here, we can total the equity of the parents. Now the non-controlling interest, so on the 1st of January 2019, there wasn't any non-controlling interest because the acquisition happened during the year. So even though the acquisition happened on the 1st of January 2019, this opening balance would be 1 minute past midnight on the 1st of January, whereas the acquisition could have happened during the day. So that acquisition of the subsidiary happened during the current year. And if we ask ourselves, where does the 452,000 Rand come from? This comes from the analysis of owner's equity. So remember when we looked at the acquisition here in part A, you can see that we had these total amounts and this represented 100%. Then we had NCI, which represented 40%. So the total of these at acquisition amounts relating to NCI is 452,000. And this is the amount that will go in your statement of changes in equity. So that is where the 452,000 comes from. Okay, from that analysis of owner's equity. So what someone is asking, what are those non-distributable reserves? So it's just a reserve that has been created that cannot be distributed in dividends. So remember, retained earnings can be distributed by declaring dividends, but sometimes a reserve is set aside where no one can distribute that through dividends, and it's called a non-distributable reserve. So now we have looked at the acquisition of the subsidiary. Now another item that is going to have an impact on the retained earnings column is the current comprehensive income, or in other words, current profit. So this comprehensive income, the 1,315,000, this comes from the statement of total comprehensive income. Okay, so here, if we go to the total statement of the statement of profit or loss, or total comprehensive income statement, you'll see that the owner's share is this amount being 1.3, and this is the amount that goes in your statement of changes in equity. So you need to prepare your statement of total comprehensive income first before you do the statement of changes in equity. So this amount is going to be there, and then so will the 280,000 relating to the non-controlling interest. Okay, so if we go down, this amount is attributable to the owners, being the parent. It represents roughly 60% of the profit for the year. Then we have, so you'll need to total that and say total equity of parent. Then in our non-controlling interest column, we'll have 280,000 Rand being the non-controlling interest share of the current year profits. And then that will total to this figure of 1.595600. And this can actually be traced back to the statement of comprehensive income. Here you can see this total agrees to the total here in the statement of changes in equity. Then we have a dividend. So remember that this dividend shown here is a dividend that is declared. So even though there was a dividend declared from the subsidiary, the dividend declared from the subsidiary to the parent, that was eliminated, and that was 6,000 Rand. The reason that dividend was eliminated is because it is an intra-group transaction. So that dividend was eliminated on consolidation. However, the non-controlling interest, their share was 4,000 Rand. And that amount, the non-controlling interests are outside the group really. So we show their dividend amount of 4,000 Rand. And then once we have that, we are totaling up here. And then this will give us all of our totals in our statement of changes in equity. Do you guys have any questions on this statement? Does anyone want to ask a question?
Yes, me again. Shouldn't we deduct the dividend of 10,000 Rand in the column of retained earnings? The total.
Okay, but who declared that dividend and to who?
The subsidiary declared the dividend to both the parent and the non-controlling interest.
Okay, but do you agree that we processed a journal entry because that dividend between the subsidiary and the parent, it's a intra-group item. So remember, in the separate financial statements, it's okay to have that dividend, but we are preparing the consolidated statement of changes in equity. So we basically see the company as one company. So if we keep that dividend there, that dividend declared of 10,000, we're basically saying 6,000 of this dividend was paid from the subsidiary to the parent. And because we view them in the group financial statements as one company, we're basically seeing it as the company declared a dividend to itself. And this isn't actually possible in accounting terms. So here the journal entry was, so that 6,000 Rand is between the subsidiary and the parent. This amount was eliminated in this journal entry over here. So 6,000 Rand was declared to the parent company. This was eliminated. And then we have the 4,000 Rand, which relates to the non-controlling interest, okay? We can keep that one because it's basically like the NCI is not in our group. It's a minority shareholder outside the immediate parent and subsidiary relationship. So do you agree that the 6,000 Rand, it cannot be shown, it's intra-group. We cannot declare a dividend to ourselves. So that is why the 10,000 and 6,000 is not shown. Only the 4,000 is shown.
Yes, ma'am, I completely agree with that. But why do we have the total amount of dividend paid in our slide number 55?
Are you talking, I think, okay, I'm not going to go to the lectures, but could you maybe be thinking of the dividends received, like confusing dividends received to dividends paid?
Not really. It's specifically written here, dividend paid.
Okay, let me stop sharing this and go to the slide. Let me just stop sharing. It was the slides today, right? Or was it last week's session?
Not today, last week.
Oh, well, I don't know. Let me just check if I have that. Slide 55.
Yes, ma'am.
Okay. Okay. So dividends received are shown in your statement of comprehensive income. Dividends paid are shown in your statement of changes in equity. So we're showing dividends paid here. Let's just see, what does the example say? The problem is that the subsidiary is paying the dividend and the parent is receiving it. So the one being shown here would be the payment by the subsidiary. So what is your question again? Because we've eliminated, so that dividend received by the parent is being eliminated between the dividend paid by the subsidiary. So we would eliminate it in both the statement of comprehensive income, where the parent would show the dividend received, and we're eliminating it here as well, where the subsidiary would show the dividend paid. So the only amount being shown is the non-controlling interest. So what is your question?
All right. So in the total column, ma'am, they have a negative 10,000 Rand. So I assume that that's not a elimination. That's not an elimination of the dividend that was written in the retained earnings, but an addition of what's happened throughout the row.
So are you referring to the slide?
Slide
So
number
I haven't,
54.
yeah, so I haven't looked at the slide because I didn't cover the section with you. But I'm assuming that there could be other dividends paid. So let me just check what the question says. Okay, so here they have the dividend income of 6,400 and they have the non-controlling interest. So I'm assuming in this question they have dividends beside the intra-group dividend. Just want to get to the information. So they have dividend income of 6,400. Let me just go up.
You can find the statement of changes in equity on slide number 43.
So looking at this, P Pty Limited declared dividends for the period, okay? And S Pty Limited declared 8,000 Rand. Let me just share it so that we're on the same page. Let me just upload this file quick. Okay, it's just going to take a second to upload. But basically what you need to think about is that okay, so the parent in our question owns 60% in the subsidiary. So if the subsidiary, okay, and the other 40% is owned by the non-controlling interest.
Sorry, ma'am, which example are you talking about?
Okay, well, I'm talking about the one in the slides, but let me just...
80/20.
Okay, let me just quickly share this. Okay, I just need to go there. It is loading. So let me just go to slide 43. But basically, you need to think about who are the shareholders, who is receiving the dividend. So when P declares a dividend, who is receiving it? The people that own shares in P, the parent company. But when the subsidiary declares a dividend, the parent owns a portion of shares in the subsidiary. So you need to think about who are the shareholders. Okay, so here, can you see this? Slide 43.
Yes, ma'am.
P Pty Limited is declaring dividends here, okay, of 10,000 Rand. S doesn't own anything in P. P is owned by other shareholders outside the group, okay? So this 10,000 Rand is not an intra-group transaction. P is the parent of S, meaning P owns, I'm not sure what the percentage ownership here is, but P owns an ownership in S,
It's
and then
80.
there's non-controlling interest, okay? So you're saying it's 80%.
Yeah, parent.
So P owns 80% in S. So when S declares a dividend here of 8,000 Rand, do you agree that P will receive 80% of that dividend, which is 6,400 Rand? Okay,
Yes.
so S is declaring a dividend. 6,400 Rand will go to P, and the remainder being 1,600 Rand will go to the non-controlling interest. So do you agree the portion of this 8,000 Rand that is going to P, that is a transaction in this group between P and S? Do you agree?
I see. All right.
Okay, so you kind of need to ask who are the shareholders. So in S Pty Limited, the main shareholder is P Pty Limited, and then you have a whole lot of your non-controlling interest being your minority shareholders. So this here, this dividend that was declared, is shown as a dividend income in P. This represents the 80% of that dividend paid, okay? So that amount being the 6,400 Rand, that is an intra-group transaction, and that needs to be eliminated. But this 10,000 Rand here, this dividend is being paid by P. S is not a shareholder of P. P is a shareholder of S. P will have its own shareholders, people that own P. So this 10,000 Rand dividend declared, this is going to people outside of the group of P and S. So this amount of 10,000 Rand doesn't have to be eliminated because P is declaring it to its shareholders, and S is not a shareholder of P. P is a shareholder of S. Does that make sense?
Yeah, makes sense. Thank you, man.
Okay. Okay, guys, that is it from us, from me.